Good day, everybody. This is Jim Kenney for the weekly market update for OptionProfessor.com. And today's date, April 26, 2019. I would like to remind everybody that past performance is not necessarily indicative of future results, and that short-term trading and option trading does involve substantial risk of loss. Not right for everybody. So do talk to your clearing firm, your broker, your advisor, and your good common sense to figure out what, if anything, might be right for you. By introduction, again, I'm Jim Kenney, and I've been in the investment arena here for decades, teaching people the uses and the risks of option trading through hundreds upon hundreds of live seminars and also webinars throughout the nation. So at the end of the day, I'm informed, knowledgeable in this area, and I'll be providing my opinion and my views on a wide variety of things that are going on. Those of you who have been here before, you know the drill. We're going to cover a lot of information, so get the seatbelt on here and let's get started. Today we've got a big day on the news front because GDP came out, right? And the number was 3.2%, which looks like a great number. And of course, everybody gets their party hats on because it's a three handle and everyone's so happy. Then they look behind the curtain and under the hood, and it doesn't look quite as rosy because a lot of the growth in the GDP came from inventory expansion and exports. And when you look at things like consumer spending, it's on a big downward deal. And then you got capital spending not going anywhere, and the inflation is really, really low. So again, that's not generally the sign of a booming economy, so you got to be a little bit careful. Again, the market's been seesawing plus and minus all day long, and pretty much as I speak to you now on the screen, you can see it's up about 30 on that, and it's up 13 on the NASDAQ. Basically, again, what I've been saying here, a little review, is that when we were at 2350 on the S&P, let's put the S&P up so I give you a little idea of what I'm seeing. Okay. S&P up here so we can talk turkey on what's happening right now. Okay. You can see that when the S&P dropped to 2350, that was a big sell-off, and we all know it was kind of driven by slowdown worldwide, the economies. And then, of course, the Fed was supposed to be doing a lot of hiking. That scared the heck out of people, and everybody dumped. Don't forget, when you're going into the abyss, or right now when it's going through the roof, there's got to be another guy on the other side of the trade, right? So somebody's buying at 2400 while the whole world's selling. Conversely, somebody's selling up here while it looks like the whole world's buying. So don't forget that. Now, when we're down at 2350, obviously very oversold versus the moving average. I was telling people that 2750 was the 200-day average, and we may go back and gravitate to that. As you can see, within a month or so, we were already up 400 points to that moving average, just above 2700. Okay, then we dilly-dallied between 2800 for a little bit, and then once it broke above 2800, that's how we get up to the new highs. So the Elliott wave stuff that I've been reading about was saying that we could go up to 2800 or so, but with an outside case of going after the highs of 2940. Well, that's what we've done. We've gone up to the highs of 2940. Now, people that are trying to do some estimating on where we could go, best case scenario they're seeing is 2950 towards 3050. So that's another 100 points up from here. I don't know that we're going to get there. Maybe, maybe not. But I do know one thing. When the VIX goes down to 11 or 12, when valuations jump to 17 or 19, when the stochastics, RSI, and other indicators are in the 80 zone, and when you have a frenzy into these IPOs, and the moving averages are in the 2700 area and you're up at 2900, anything between here and 3100 would be a stretch in my view, particularly if the consumer spending has been drying up like it seems to have done, because 2/3 of economic growth comes out of consumers. Now, you have to recognize retail sales came out and they weren't bad. So we could see better Q2 numbers. That's possible. But there's also a situation called earnings. And everyone's talking about how a lot of these companies are beating estimates. Me personally, I'm not so interested in beating estimates. I'm looking at year over year. And last year, because of the tax cut, you got a big sugar high and a big jump in earnings last year. So if you compare year over year earnings, they're not looking very good across the board. And if you miss, believe me, you're punished pretty well. I'll get into a few stocks that have not done well after their earnings came out, and I'll give you an idea. But there could very well be an earnings recession here. And that means that your earnings may fade off of what the numbers have been. That doesn't mean you have to have an economic recession necessarily, but it could very well mean that the earnings are going to dry up a bit. And that's a rough racket for stocks to go up. Well, let's put it this way, for all stocks to go up if they don't beat on top line growth and if they don't beat on net earnings. So you got to be careful on what you're holding on to, I think, now, because the selectivity may increase dramatically. And if any of the companies are having any trouble getting sales to grow or retaining profits, they could be punished accordingly. And I think some of them have been already. A couple of other things I'm watching here: uh, not insider, but buybacks. Buybacks have been tremendous. 59% jump in Q1. We did $1 trillion, I read, in buybacks last year, and a lot of people think we're going to match that number this year. 2 trillion of buybacks is a lot of buybacks, okay? And that can kind of skew the PE ratios because now you got less stock dividing into the what, into the earnings, and so that can kind of, skew things a little bit. Meaning, the same amount of earnings could actually show a 10% jump in the relative relationship because of the situation of the reduced share count. Okay. Also, you got more dollars chasing fewer shares. That can be an issue as well. At any rate, the buybacks have gone crazy. So if you want to know where your tax cut went, it didn't go into the measly wage increase we're seeing. Although next week we're supposed to see wages jump anywhere between 2.5% and 3.5%. But certainly that's not anything like it could have done if they didn't buy their stock back with the money. Also, next week we've got Google and Apple coming out, and at the end of the week we've got the jobs report. So plenty of wood on the fire here as we continue on. And some of the techs are doing okay and some of them not so okay. But again, the big thing that people are not talking about is the potential for an earnings recession, meaning when you look at year over year earnings, they are not keeping up pace. And in fact, in some cases, they're down. It's kind of like if you're looking at the stock market, it looks fabulous across the board, but then you're looking at a few different sectors and companies that are not doing so good. So you got to be careful of that. Just like this report, 3.2% jump in GDP, but you peel back the onion and you see some stuff that is not being announced on the headline, right? So sometimes that's the case. And there's been the winds of change blowing a little bit. President Trump has come out and made some comments about lower oil, and that hasn't been welcomed news to the bulls on the oil market. In fact, it's been very unwelcome today. Let me see anything else that I wanted to cover real quick here. We're going to go around the horn, and let's start out like we did with the S&P. So what am I saying on the S&P? I'm saying we've hit my objective area in this high area of 2940. We're at 2933, and it's been as high as right around 2940. Could we break through it? Since we're knocking on the door, it looks like it might want to. And so what would be the window that I would be looking for? 2950 to 3050. And then, you just don't want to stand in front of a freight train. What you'd like to see is the market give you a formation or a pattern. Once it's into this higher range between here and 3100, give us some kind of a pattern that shows us that there's a high surrounded by lower highs or some type of evidence that the market might be turning. Again, we are getting into an extended price over the 200-day average. That's a good thing if you want to see the market pull back. And then, of course, a high surrounded by lower highs on either the daily or weekly graph would be a welcome thing because then you have a point to defend against. Right now, you're stepping in front of a freight train, and that's generally not healthy for your health. So, again, I think we're getting up into the upper echelon. I think the covered call writing, the collar strategy, the married puts, that time is either here or coming. And I think that replacement ideas where you get rid of a stock position and replace it with long calls. So obviously, to give you an idea, if you're long a stock and you got a $40 gain in it, you take 40 off the table and you buy a call for $5. If the thing goes south on you, the $40 you took is in your pocket, and the only thing at risk is the $5 call price. Again, there are things that I'm talking about, and because of the confined nature of the broadcast, I can't get into minutia. So if you have a question on hedging, if you have a question on something that you either own or don't own or thinking about owning or whatever, and you'd like an opinion, you'd like a view to put into your mix, it's simple. You go online, you shoot me an email, OptionProfessor, ProfessorProfessor.com. OptionProfessor at Gmail. And then boom, it comes right over to my Gmail account. And just give me a way of corresponding with you, a phone number or time of day, something, okay? And I'll be able to try to throw in some insight that may or may not be helpful to you. All right, all right. Let's see what else is going on here. The Nasdaq has been trying to make new highs, but I'll tell you why. Again, I have a little bit of a caution flag in this neighborhood. You know, you're never going to pick the high. Let's be not crazy. You're not going to pick the low, but if you can get in the county of the high and the county of the low, meaning a general area, you have a decent shot of putting on some things that might work for you. And, you know, if you have some staying power, it's not bad. Now, here's a couple of things that I'm a little bit concerned about as far as the market's concerned. One is the Russell. Now, the Russell today is having a good day. It's up 15, and it's had some trouble at the 1600 mark. If it gets through here, 1650 is also, right? And the all-time high is 1742. So we're a good 10% underneath the high of 1742. Is it going to make a run for it? I think it might make a run for 1650. But I'm looking for patterns where it shows that we're exhausting. I don't see them yet, so obviously you can't do a lot of selling or getting positions you're hoping will be pulling back. The big support lines on the S&P, I forgot to tell you this, in my view, 29.15, which we tested here the last day or so. I think yesterday's low was 29.12. Today's low was 29.17. So that neighborhood I'm talking about, 29.15, that's not bad support, right? Okay. Now, underneath that is the more significant support, and that's 28.65. If we start blowing out 28.65, 28.50, I think that whatever highs we've seen now may be intact for a while, and you could get a more pronounced drop or pullback if we can break that support. So you got a couple of lines in the sand to keep an eye on if you're following the S&P. 29.15 ballpark plus or minus, and 28.65 ballpark plus or minus. Keep those numbers in mind. And again, on the upside, 29.50 to 31.50, excuse me, to 30.50 would be a sweet spot with an outside chance of 3,100. Again, when and if this thing does hit a high point, it doesn't take forever to roll over to the downside. So it's nice to have your strategy ready to go, as well as your tactics, and then just wait for the pattern to develop. And then once it develops, hit it. Okay. Let's take a look here at another thing, which was the transports. And they had a pretty good size run, you know. But again, some of those have turned over a little bit. And let's take a look here. You're up 25, but can you see it seems like it peaked out this week here, and it seems like it's losing altitude. So if this thing starts taking out 10.5, I think that that would also add some credence that maybe the short-term highs are on in the stock market. So I'm looking at other indicators like the Russell, like the transports, because they've been very helpful on indicating direction before the S&P. And so I like to look at them. And again, I'm getting a little bit of a sour taste in my mouth with the transports here. But 1 day or 2 days does not make a trend. Okay, so keep an eye on that. And again, how these earnings come out and how this unemployment comes out next week. And then, of course, Powell's going to be talking. So they're going to be hanging on to every word. If he comes out with things like, we're considering an insurance cut, which some people are talking about, meaning they cut interest rates as an insurance in advance of what they think could be trouble, that could either be off to the races for stocks because now the Fed's really not in the picture, or it could be a warning shot to stocks that valuations do matter, earnings do matter, and if the valuations are high and the earnings stink, it's going to be hard for stock prices to hold up their water. So again, a lot of stuff going on next week that you have to be careful on. Again, these hedging tactics are very valuable to know from time to time because they have a way of keeping you in the market, but also reducing your risk. And that's not a bad thing to know about. So again, shoot me an email, optionprofessor@gmail.com, if you have any questions, and let's go to it and let's get through it. Okay? All right. So we went over those two things. Let's see what else. Well, let's talk about some stocks that came out and when they didn't get the numbers they were looking at. This is a sector here that seems like it's way out of whack. And this is called the semiconductors. Okay, they're saying South Korea, which has a negative GDP right now, is saying that the shipments of the semiconductors and the chips, has not been that great, right? And so this thing has gone, as you can see, through the roof. And now it might be coming back to reality because that looks like a little bit of at least a temporary high point, if not the high point of the move. And so only time will tell if that's the case. But 80 to 120 is a 50% move, and that's a big move in 3 or 4 months. And obviously, you should have some fundamental, shall we say, confirmation, which means the chip should be coming, the shipment should be huge. And according to what I'm reading, it's not. And South Korea, which is pretty much in the thick of it there, their GDP has actually gone negative, I heard. So again, the China situation, which I'll get to in a minute, is improving internally, but their imports are not improving. Their exports are improving, but their imports are not. And that's why you see the countries all around the emerging markets not having such a great time of it right now, because China is a big engine over there and they're not helping the other countries. What's happening is they're helping just internally with China with all the easing and accommodation that they've come up with. So anyway, getting back to this thing here, semis, if you look at like NVIDIA, you see that NVIDIA as well, the bloom has come off the rose here as well. Okay, so there's a little bit of an indication, and you're down 5%, which is nothing, not nothing. The indication is it's possible that we've seen the rally on the chips for the time being. The other rally that we might be seeing come to an end is also in the energy sector. Crude oil itself is down about 6%. Let me double check that. About 6% down in the crude oil in the last couple of days. So that's a pretty good turn. Now, Exxon came out with their numbers and they weren't very great. So they're having a hard time making money and getting their stuff going right now. And the stock is under 80. You can see 80 is kind of a big neighborhood here. So keep an eye on Exxon. If it starts trading well under 80, 75 is the next spot. And then after that, down to 70. So if the party's over in oil, meaning we're not going to go higher than 67, 60, 650, where we just hit, it's now trading 63, did hit 62 area and change. So if the party's over in oil and you had gains, this is the time where you might want to start hedging them, because you don't want to start hedging them if it drops all the way back down to 70. Now, if you think this is just a temporary pullback and we're going through the roof, then you could just sit tight and just view it as that. But, some of these stocks don't look as good as they used to. Exxon's one of them, and Chevron is the other. Oh, there's your Chevron chart. Nothing to write home back there. Used to be up at 112. Now it's down at 104. That's about an 8% drop in a pretty short time. So is the party over in the energy market? Well, the numbers are starting in the upper left here and starting to come down a bit. So you have to be a little bit careful. Again, if you had big gains in this stuff, some type of hedging technique might not be the worst thing to think about. Okay, so there you go in the oil sector. And then let's see how the banks are doing, because everyone's jumping up for joy that the banks are going to do all these great things. And let's see what happens right now. Okay, the best of class is what they call this place, JP Morgan. It's hanging in there. It's hanging there, but you got a big gap there between 105 and 17. And if they the candles get blown out here, you could come back down and fill that out. That would not be off the chart. And then the other ones that I keep an eye on is Citi. And Citibank is, where is it? It's up a little bit today. It's come up pretty good, but again, it's not at their 52-week high at the 75 mark, and but again, it's had a big rally off of the 52-week low in December. So the banks are still looking like they're hanging in there, and there are a couple of banks for those people who think the emerging markets might be good. I'll just show you a couple right now that people are looking at. One is in South America, and it's Banco Bradesco, and BBDO is the symbol. And this just gives you an idea of what a Brazilian bank is trading like. And it's at 787 today, and it's got some support, it looks like, in the 750 area. And let's look at the moving averages here. I like to look at the moving averages, 50 in the 200-day, give me an idea of the trend, give me an idea of what's going on. So here you go. You're at 750, 775 on the 50-day, and you've got 684 on the 200-day. So that's not a bad setup. And currently trading 787. Another one out there is Mexico Bank, and that is Banco Santander. And let's take a look at that. and that is at 823. As you can see, it did pop, right? Yep, it did pop. And let's go look at what's going on in the moving averages there to give you an idea. But I'm sure they look pretty good because the price action has been pretty good. Moving averages don't tell you exactly where things are going. They only work off prices already known, but they give you a little bit of an idea of a flow of action, right? The flow of action over a period of time. There's a 50-day moving average at about 702, 200 days at 715. They're just about ready to invert as long as this 824 can stay above 715 for a period of time, which right now it looks like it's trying to do. So there's a couple of international stocks that people don't really keep too much of an eye on, but might be interesting to keep on your radar. Another international utility that people are looking at a little bit is Enel Americas, which is a utility company in Brazil. And that one is going for 887. And let's just see what that looks like technically. It's been going sideways. And so it looks like it needs a little bit of news to get popping. If it's going to pop at all, P ratio looks pretty low. And you're looking at 893 and 861. So they're inverted to the upside, and it's at 87. So I'd like to see this thing trading above above 9. And certainly if it starts trading above 10, it would be taking out that resistance right there, and that'd be a good thing. All right. What else is going on here is some of the stocks in the news, like United Healthcare. Last week, I brought to your attention that the volume on the drop was enormous and that it might be a climactic drop and it might be worth taking a shot down there if you had to stop under 208. 208 was the low. Look at that volume right through the roof. So you take a shot down here and you put a stop under 208 and maybe it goes back up towards 240 and looks what it did. 236. So when you see the volume that big, that means Tom, Dick, Harry, and everybody else is sold out. That's huge volume. And like I told you, somebody's got to be buying if everybody's selling. And if everybody stops selling, then of course it can snap back. And that's what's just happening here. But when you go into the abyss and you got a big company like this who makes tons and tons of money, and you are down here under, from you used to be 280 and you go down here, once it stops making new lows, okay, then you can take a shot and put your stop underneath it. That's exactly in reverse of what I'm looking for in the S&P. Let's get that S&P to show me a high point surrounded by lower highs, and then consider some selling strategies looking for a pullback. But don't step in front of freight trains. Marty Zweig used to always tell us, don't fight the Fed and don't fight the tape. And that's not a bad philosophy. Okay, what else do I got cooking here today for you guys? Let's talk about that U.S. dollar. Okay, on the U.S. dollar, it's at 98. It's strong, right? Very firm. I was thinking that it might roll over later in the year. I think Trump wants a lower dollar, so I don't know if he's going to get what he wants or not, but getting under 95 is the key. Getting under 94 is the key. If it gets under 95 and 94, you could get a substantial drop in the dollar. If not, the yield difference, we're paying 2.5% or something like that on a 10-year. You go around the world, people are now going into there buying our treasuries to get the 2.5, and a lot of them are doing them unhedged. That means they have currency risk because they think the dollar is very safe, right? Well, if everyone's doing something, that raises my hand. Maybe I don't want to do it. So the bottom line is that if this dollar is going to start dropping, the people that are buying these treasuries to get the 2.5 unhedged, they may have to do some hedging on the dollar, and that could be something to look at in the days and weeks ahead. If the dollar ever does drop, I think it will be helpful for the gold, but it has not, and so gold is giving back a lot of its gains. The mining shares have gotten whacked pretty good here, but I brought to your attention when we're up at 23 and the moving average is down at 20 that it could have a pullback, and that's exactly what it has. You got lower highs, lower high, boom, lower high, boom, and then they took out this area. Okay. Now, today it's up a little bit, up 2.5%. Again, the moving average come in, I think, right around the 20 area. So take a look here. And by the way, the moving averages on Exxon are all around 79, 80. So the fact that we're underneath the moving averages potentially is not a positive. So that's why I say if you start breaking substantially underneath 79, that's going to get the people following the moving averages to bail as well. Okay, here you got 2183, which is above the 2050, 2046. So again, staying above 20 and a half would be very nice, or at least 20. 20 would be good. Okay, it breaks under there, then maybe the dollar is going to 100 for all we know. And with no inflation of 1.3%, it's going to be a rough racket for gold to go anywhere but down if inflation doesn't show up at all and if the dollar gets very firm. Okay. What else do we have here for you? We talked about the oil having the pullback. Let's talk about emerging markets because I think a lot of people are running into there like they're in some kind of a risk-free investment. And I think that's crazy. But take a look at it here. EM has had a little bit of a pop. This is the ETF. It's gone from 38 to 45, now pulling back to 43 and change. Here's the problem with this. A lot of people are on the come line here, betting that things are going to be better over there, but the dollar's strong. That's not good for EM, right? And some of these economies over there, I just told you, South Korea, I heard, announced a negative GDP. So some of these people are not in a position where their economies are going very well at all. And China put a ton of money in stimulus, but really they're exporting a lot, which is good for them internally, and they're doing internal spending, which I'll get to in a minute with Alibaba, Baidu, and a few other ones. But the thing is that they're not helping the region. And that's why I think you're seeing some of their currencies. The Aussie went underneath 70. New Zealand is way under 70. And you've got Japan, not exactly, robust with this. And then South Korea, I just told you, their economy is kind of stinky. So the bottom line is that I'd be a little careful of emerging markets because, again, there's a lot of risk in the emerging market debt now. Again, I'm going to get into the debt market in 1 second, right after I quickly go over China for you. BABA, I loved at 130, 140, 150, and it ran up real nice for us. Let's see. I think it's running out of steam, though, a little bit. It went up to that 190 area. And of course, it's not as good as it was at 130 or 140, right? And now it looks like it has a lot of problems at 190. If it breaks under 180, 170, then this Chinese recovery that we're seeing could also start fading out as well. This could just be a snapback that fades. If we get above 190, 200, then it looks very, very strong. Let's look at the moving averages real quick and show you where they're at. Yeah, see 177 over 164, that's not bad. And again, could we go back towards 164 on a pullback? Yeah. The other thing I've been telling people is on most of these stocks, a lot of them, the volume has been drying up. This thing had a huge rally, but in the last 50 days, the average is only 11.9 billion shares. And here, million shares, I'm sorry, 11.9 million shares a day. And that's the average. And then you're at 18 million on a 200-day. Now, I don't know about you, but if you're getting into rarefied air and the volume is drying up, that might not be a good thing. So we'll have to see. They say there's a lot of money on the sideline and they could drag it in. Maybe the money's on the sideline because they don't want to take a risk and therefore it's not coming in. There's a couple of different ways to look at that. Baidu, another one. Let's see how that's doing. That really didn't go up very much. It's 166. It's only about $10 or so off the low. So it has not really recovered at all. And that is not something that's showing much. So maybe the other one's out of line a little bit. Well, only time will tell. Real quick, I want to go over the interest rate market because, bonds and interest rates are very important to people. So the Treasury, as I told you last week, was banging up against 260, you see? And 260 is resistance. You see, lows, 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 resistance, and it's backing off. So the path of least resistance remains for lower interest rates. If we get above 260 and get above 280, then the path for higher interest rates would be intact. But that's not the case now. And you can't, deal cards that you don't know. So right now, it's still for lower rates. Some people think we're going to go down to 225 on the 10-year by the end of the year. That's going to happen if the earnings recession continues, and that's going to happen if you're looking at a situation where the dollar gets very strong and the GDP numbers go back down. Now, if the GDP numbers go to 1%, that's when you got to worry about things like high yield. Okay, because there's leverage in high yield, and there's leverage in investment grade, and there's a lot of leverage in in loans throughout the world. I mean, I just was told $13 trillion of household debt going on. That's a record. We've got 10 trillion in negative yielding bonds, meaning if you sold them, you don't even get your principal back, even if you hold them till expiration, maturity. The third thing, we got 10 trillion in junk, high yield, and triple Bs and leverage loans. Leverage loans are only going to be good if rates are rising because they're floating rates. Who's going to want a floating rate if rates aren't rising? So you got to be careful in leverage loans. They're dangerous to begin with. Now here, you got high yield. You start taking out 86 on this and 85, then you got to be concerned. Keep an eye on it because again, if the covenants of the bonds are weak and if you're looking at leverage and if you're looking at the GDP coming into 1 or 2%, people may look very differently at high yield than they do right now. It's had a very big run. If you want to know what can happen to these bonds under certain circumstances, when people run for the hills on stocks, they definitely run for the hill on bonds, it looks like, because there's your corporate bond market going way down back in what? Back in December. Okay. So be careful of your high yield market. Be careful of your leverage loans. Also, be careful of emerging markets because, again, those economies over there don't seem to be doing all that well. And again, there could be some problems. South Korea, like I told you, a negative GDP certainly is not great. And so be careful of the emerging market debt, leverage loans, and high yield. Not today, right this second, but again, if GDP does come back in, a lot of people think it might because again, inventory spike up is what and exports is the thing that kicked it up this time. Consumers are 2/3 of the economy. The last thing you want to see is a chart on Bloomberg showing that the consumer spending is going down. That's not what you want to see when you're long stocks because you need that consumer out there spending what? Spending money. A couple of other big stocks in the news. Again, I told you Google and Apple will be announcing next week, Monday, Tuesday. And then you've got Amazon today, and it was trying to make a big rally. It went up towards 1949 and it's down to 1944. So spiked up a little bit. If this thing starts breaking under 1900 next week, I think that might be telling us something. Keep an eye on Amazon. And Facebook was another one that was doing well for a little bit after their earnings, but that seems to have gone south as well. There you go. So you can see it spiked up to 200 and now we're already $10 lower. Be careful out here. That's why I'd want to know how to do hedging. How do you do hedging with collars? How do you do hedging with married puts? How do you replace long positions with long calls? How do you do these things? If you're not sure, shoot me an email, optionprofessor@gmail.com. I wish you all a very, very good weekend. I'm sure next week is going to be very active as well. Fed speaking, what do you call it? Amazon and Apple and Google, plus the unemployment report. A lot of firewood on the fire next week. We had a very big run now, and we'll have to see if this thing can hold water. Like I say, 2950 was where I thought it would run up. Test the high, exceeded a little bit. We've already done that. Are we going to go to the upper band, which is 2950 to 3100 ballpark? I don't know. To do that, we're going to have to get another power, and maybe that's why he's talking about some kind of a deal with China. Maybe that would get us going for that last hurrah before we have a more significant pullback. Again, the market's been very strong this week. Only time will tell if it'll stop making new highs next week, and then of course that might be your first indicator that the thing is slowing down. All right. Lots to talk about next Friday. I'll be with you. If you have questions, shoot me an email. I'm Jim Kenney. And until next Friday, good luck and good trading. And of course, have a great weekend.